This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, in our previous lecture together, we saw how it was that the personal allowance may be restricted. It'd only be restricted if adjusted net income, as we referred to it, exceeded £100,000. What we're now going to see is not a restriction in that personal allowance, but the ability for one spouse to another, or one civil partner to another, to transfer an amount of their personal allowance to the other spouse or civil partner. How the transfer works, we need to look at. We also need to understand, why would you do that? So, an election may be made. It is an election, so we're only going to do this as taxpayers if it improves our tax position, to transfer a fixed amount. This is not just any figure you want, but a specific fixed amount. That fixed amount, 10% of the personal allowance, to a spouse or civil partner. So whether you're married with a spouse in a civil partnership with your civil partner, you may transfer 10%, fixed 10% of your personal allowance. Now, we know that our personal allowance for our tax year is £11,500. So times 10% will be £1,150. And that's known as the transferable amount of the personal allowance. Now, that figure, rather than the 10% figure quoted there, that figure is provided to you, again, on your rates and allowances pages with you in the examination room. The transferable amount of the personal allowance. So, this is only available when both taxpayers are either just basic taxpayers, or basic rate taxpayers, I should say, or indeed that we'll find that one of these is likely to be a non-taxpayer. The election only really likely to be made when one spouse is a non-taxpayer. By that we mean, as a non-taxpayer, they are not using all of their personal allowance. Some of the personal allowance is therefore being wasted. We wouldn't want to waste something like a personal allowance, which is a level of tax-free income, not if some part of that could be transferred over to your spouse or civil partner. What we see here, therefore, is when one spouse is a non-taxpayer, has an amount of unused personal allowance that would otherwise be wasted, and the other spouse is only a basic rate taxpayer. So what you're looking for, where this is going to be, again, a good idea, suggestion that you would make, a proposal to improve the tax position of the taxpayer spouses. We'll just stick to the word spouses now rather than keep on saying civil partners as well. But whenever we say the word spouse, whichever tax we're talking about, in tax, we always mean civil partners as well there. So it's only where we're going to have one taxpayer who has income below the level of the personal allowance and is therefore not even a basic rate taxpayer. They're a non-taxpayer. And some part of their personal allowance is otherwise being wasted. Now, what we can't do is simply say, I'd like to transfer the unused bit, the wasted part. No, it is this fixed amount of £1,150 worth of the personal allowance. There's a time period there in which it must be made, this election, which is interesting because this works in one of two ways. It can be made within the 4 years of the end of the tax year to which it should apply. So you can look back on a tax year once you know the exact levels of income of each particular spouse and decide, is that going to be worthwhile this year? So we'll make that election. Or what you can do, as it says here, if you make the election, if made within the tax year concerned, the election will then remain in force for future years until either it is withdrawn or the conditions are not met. There, basically, with the conditions not being met, one of the taxpayers would be a higher rate taxpayer. Can't happen. It's either both a basic rate taxpayers, in which case usually there's not much point in shifting this transferable amount of personal allowance from one to the other, though in some very specific circumstances it might still be worthwhile. But the circumstance you'll be looking out for, one of the spouses is a non-taxpayer and the other is a basic rate taxpayer. If that is a situation that repeats itself year after year after year, then you can make the election within the tax year. It will then be applicable for not just that, but for future tax years as well. If your situation changes, no problem, you can withdraw that election. But how does this relief work? Clearly, the personal allowance of the transferor spouse is reduced by £1,150. But that £1,150 then does not actually transfer across and increase the personal allowance of the transferee spouse. Instead, what the transferee spouse benefits from is a tax credit, a reduction in their tax liability. And that's explained here. The relief is given as a tax credit to be deducted in deriving the tax liability of the transferee taxpayer. And as a tax credit, it is computed as 20%, so that's the basic rate, 20% of the transferred personal allowance, which, as we said, for 1718 would be computed as 10% of 11,500, the 1,150 we've shown there, at 20%, so a tax credit of £230. So the transferee spouse does not get a higher personal allowance. Instead, they get a reduction in deriving their tax liability equal to £230. This fixed transfer amount of 1,150 taken at 20% is £230 as a tax credit. What do you do with it? It obviously will only reduce the tax liability. It can't create a repayment. So if the transferee spouse is barely even a basic rate taxpayer, so that the £230 there removes all of the tax liability of the transferee, say £200, leaving therefore £30 remaining, you don't get that back. It will just reduce their liability to nil. That amount of the transferable personal allowance, this £1,150 for the 1718 tax year, as we've said, given in the rates and allowances. You may also see reference in other texts there. You'd be using, I trust, an exam kit from one of the ACCA approved providers, and that could be known as the marriage allowance or the marriage tax allowance. We're talking about one and the same figure. Now, I've got a little example here, example 11, for us to have a look at. We've got our famous spouses here, David and Victoria. I suppose I should be talking about, I must update this to Harry and Meghan maybe these days. But David and Victoria are married. And in our tax year, 1718, David has a trading income assessment of £8,000, whereas Victoria, the rather better off spouse, received a salary of £30,500. Now, again, without doing any calculations other than simple arithmetic in your head, you can see that David, with income of only £8,000 there, has income less than the personal allowance, is a non-taxpayer. And on £8,000, some £3,500 of the £11,500 personal allowance would effectively have been wasted. Whereas here, Victoria, she's got a salary of £30,500. She will use her full personal allowance of £11,500 and be left as a basic rate taxpayer. This is the situation in which this election is worthwhile. What have we got to do? Calculate the income tax liabilities for both David and Victoria, assuming that an election is made to transfer the 10% of David's personal allowance to Victoria, and then, of course, stating the date by which the election must be made. Again, you can look back to the note above and, again, write that in when you look at the answer to this. Right, looking at their tax computations, therefore, so far as David is concerned, his income tax computation, we know the outcome is not going to be a taxpayer. But he would have his salary of, so if this was David, therefore, he's got a salary of, how much was it there? Sorry, not a salary, I beg your pardon. He's got a trading profit. My apologies. Not that it makes any difference at all. But he's got his trading profit of 8,000. That's it. Now that's non-savings income. I'm not going to bother with the columns because we don't need them because there's nothing taxable. And he's got a personal allowance available to him. Now remember, he has transferred 10% of the 11,500. So 11,500 minus the 1,150 transferred will be a personal allowance of, I think, £10,350 there. And that will bring us down, of course, to nil taxable income. Now, irrespective of whatever level of trading profit here that David had, the revised personal allowance for the transferor will be that. So had David's trading profit been 10,000, we'd still be deducting 10,350. And even if he had a trading profit of, say, £11,000, you would still be deducting 10,350. It's a fixed amount that is transferred. You don't say, oh, well, that would still leave him with taxable income of, what, £650. So maybe we reduce the amount that transferred. No, it's not flexible. It's a fixed amount there. So watch out. Don't be tempted to think, oh, well, maybe I give 11,000 personal allowance still to David and only transfer the remaining 500. No, it is a fixed figure. Watch out for that in an objective testing question. Okay, so David, no tax to pay, and 10% of the personal allowance has been transferred across to Victoria. What's Victoria got? She's got the salary. And her salary, £30,500. She has her personal allowance, £11,500. That doesn't change. It is not the personal allowance that is available to her, the increase, the transfer. It is a tax credit that is available to her. So we take out her 11.5, just as you would normally do. So that will bring us down to, what, £19,000. We will then calculate the tax on that. It is, of course, non-savings income. And on that non-savings income of £19,000, sorry, there's your taxable income. That will all be at 20%. So 19,000 at 20% will be £3,800. That would have been Victoria's tax liability, but less now the tax credit that comes along, the personal allowance tax reduction. And that, as we know, is £1,150, figure given in your rates and allowances, times 20%. That, therefore, as we already know, is a £230 tax credit to be deducted there. Okay. Have another look back through what we've just done. Check that answer out then again with the answers in the back. Before then, we will move on from our personal allowance to not something often seen, to be fair, on the income tax computation, but there are sometimes deductions from total income to be deducted in deriving net income. And those are either of two things: qualifying interest, or, as we'll see in Chapter 7, loss reliefs. Again, if you just pause at this particular point in time, check through the answer to that previous example 11 there, and then join me again for us to quickly deal with the deductions from total income. Okay, hopefully therefore no problems with understanding the answer to David and Victoria. And now, as we just introduced a moment ago, the deductions from total income. Now, the only ones that we need to know about are qualifying interest, and as we said, we'll see in Chapter 7, there are certain trading loss reliefs of the taxpayer that will serve to reduce total income there, and therefore must again be shown on the income tax computation. Main thing for us to be aware of, what are these forms of qualifying loan interest? As we said back in our introduction to this chapter, all your main reasons as to why you'd have a loan and you'd pay interest thereon, like you've got a mortgage to buy your house, you've got a loan to buy a car, none of these achieve tax relief. And as we'll see here, they're usually to do with work. So on a loan to purchase, an interest in a partnership, or a contribution to the partnership of capital or loan. You're putting money into a business there. It's business, it's work related. To purchase plant and machinery for use in the business. And again, that is a loan taken out by a partner within a partnership to buy the plant and machinery for use within that partnership business. Again, a loan to purchase plant and machinery, this time by an employee, if used in the performance of their duties. They'd expect, of course, that in most employment, if there are items of plant and machinery required, that the employer would provide that. But if not, then so be it. If the employee has to borrow money to buy that equipment, pays interest on that borrowing, that interest payment is an allowable deduction. Or here, on a loan to purchase an interest in something called a close company. Now again, they are not within your syllabus, it's just the recognition of a name. If you see borrow £10,000 to invest in a close company, then the interest payment on that is qualifying loan interest. What they are and the significance of them, you will see should you ever decide to go on to deal with advanced taxation in the P6 exam. Example 12, therefore. Now, because this is just a very basic exercise, you get to total income and you deduct either the qualifying loan interest and or any trading loss reliefs to bring you to net income, take off your personal allowance, get your taxable income and then proceed to tax. You are going to have a go at this example. Income tax liability is required, trading profit of 50,000, non-savings income. Paid £1,000 interest. Read the question carefully. We're used to seeing received interest. Therefore, read what is there, not what you think is there. Paid interest, £1,000 on a loan to purchase plant and machinery used in the business of her partnership. One, as we've seen above, of the qualifying loan interest payments. So all you've got is to put together a computation where you've got your non-savings income and your total. You don't even need to do your total column because there's only one type of income. Again, if you're doing an objective testing question, you'll do it as quickly and easily as you possibly can. You've got £50,000 of trading profit. That will be your total income. You've got a £1,000 deduction from total to net. That net income will be 49. You then take away your personal allowance and then you then proceed to apply the tax rates applicable to that level of non-savings income. So again, I'd ask you to pause at this particular point in time, work that through, check it out with the answer in the back, hopefully no problems to that, and then rejoin us again, where we'll then move on to possibly the more interesting, well, it's certainly the more interesting, it's the more difficult area so far as this session is concerned, and one of those concepts which is possibly one of the more difficult concepts to get our heads around as well. So you might want to take a little break at this particular point in time, not just to work that example, but to get your head clear for what's coming up as well. Well, having dealt with qualifying loan interest payments, we now move to an area of payment that is far more likely to be seen within one of the exam questions that you have to undertake. Here in section 5, we're looking at payments to charity, so donations to charity made here under the so-called gift aid system. And though it's a different type of payment, the tax treatment is exactly the same, hence we join them together in this section, where an individual makes a personal pension contribution. Now, as I said earlier when we were looking at section 3 on the personal allowance and the restriction of that personal allowance, the area of pension contributions is something that we have our own separate chapter on. It's chapter 10, and that awaits us, well, quite a long way down the road before you get to chapter 10 there. And we'll look at the nature of the different pension schemes, how it gets tax relief, etc., etc. All of that awaits us in chapter 10. But here at this point, we need to understand how these impact on the tax computation as we've seen it so far. So, payments to charity under the gift aid system. Now, when we made a qualifying loan interest payment, that was a deduction from total income to give us net income. These two types, the payments to charity, as we said, under the gift aid system, or payments into our personal pension scheme, personal pension contributions, neither of these will show on the face of that income tax computation as a deduction. So whereas qualifying loan interest payments achieve tax relief by reducing the amount of income chargeable to tax, they will serve to reduce the taxable income figure. These two types of payments, donation to a charity under the gift aid system or a contribution into your own pension fund, a personal pension contribution, neither of these will show up as deductions. So tax relief must be given in a somewhat different way. And that's what this note explains, and then we'll move on to illustrate how it impacts on various areas, like, for example, the restriction of the personal allowance when we have to compute adjusted net income, as we saw a couple of sessions ago. Right. The gift aid system, it's a tax-efficient way by which to give money to charity, and is available to all taxpayers. Now, some taxpayers will only be basic rate taxpayers. More likely, of course, the taxpayer that we may have to deal with in an exam question will be a higher rate taxpayer, and very occasionally we may get up to the giddy heights of being an additional rate taxpayer. What we've seen about these particular payments so far, and again, that was back in section 3, as this note says here, is that both our gross gift aid payments and our gross personal pension contributions would be deducted in arriving at, remember, that adjusted net income, that ANI, that adjusted net income figure, which of course is the figure used in determining what restriction will there be in the personal allowance of the taxpayer. Now, it refers there to gross, so we've got to understand the difference between what is the gross amount of the payment, what in fact is the net amount of the payment. So let's go back to note 5.2 for basic rate taxpayers. Payments to a charity under the gift aid system are treated as being paid net of the basic rate of tax. Remember, that's at a rate of 20%. For a basic rate taxpayer, relief at the basic rate is automatically obtained, as payments are made to the charity said to be, hence the gross and net words, net of basic rate relief being given at source. So, if a taxpayer wants to donate to a charity, if you want to give a charity an amount of £100, then in fact the taxpayer need only actually make the cash payment, pay over a cash amount of £80. The charity will then be able to get not just the taxpayer's £80 cash received, but they can then go along with their gift aid statement for that taxpayer to HMRC and say, this individual has given us £80 of their taxed income, cash out of their taxed income. And on that, they would already have suffered basic rate of income tax at 20%. So the way that we now work out the benefit to the charity is the charity claim back from HMRC the basic rate tax of £20 that would have been collected by HMRC from the taxpayer's income. So if a taxpayer started off with income of £100, they lost 20% in income tax at the basic rate. So they were left with £80. If they then pay that £80 to their favourite charity, the charity then, under this gift aid system, are able to take not just the individual's £80, but go along, as I said, with the gift aid statement to HMRC and say, give us the £20 tax that you collected from that taxpayer when they received net of tax that £80 net cash. So for your £80, the charity gets £100. Now, of course, that seems like it's just the charity that's benefiting. But I guess if you think about it, if you wanted to give the charity £100, now through this system, you don't have to. You've only got to give them £80 and the charity still gets the 100. So that's the theory behind it, but what have you got to do in terms of dealing with an exam question? So a question may tell you what is the amount paid by the taxpayer, for example, £80, and you then, from that net figure, have got to work out the gross. We're always going to need to find the gross figure. So how do you gross it up? 80 times 100 over 80 will bring you back to £100. Again, 80 is net of 20% tax. It is 80% of the gross figure. Therefore, times 100 over 80 gives you that gross figure. That will be used to compute the gross figure. Or instead may state that the amount paid was £100, then actually state in brackets next to that number gross. So although you actually paid 80, they're not getting you to work the gross figure, they're giving it to you. Now it does mean you've got to read the question very carefully. If it's £100 in brackets gross, bang, that's the figure that you want. What we do with it, we'll see in a moment's time. If they tell you just, this is the amount paid, £80, you've got to work the gross figure of 100 by taking whatever is the amount paid times 100 over 80. Therefore, the donation is not shown as a deduction in the calculation of taxable income. We started this by saying that the way in which you got tax relief from your qualifying loan interest payments was by deducting the gross amount of interest that you had paid to the financial institution from whom you had borrowed. You deduct that figure from total income, deriving net income, and in turn deriving taxable income. So your income was that much less. You achieved tax relief on the income tax computation. Here what happens with gift aid payments, and it is the same as we'll mention at the end here for personal pension contributions, is that you are said to gain basic rate relief at source. So if you paid 80, then the gross is 100. You paid £800, the gross is £1,000. You paid £400 into the charity, the gross is 500. With exactly the same system for personal pension contributions, it's just the numbers will be bigger. We are likely to be paying rather more into our own pension funds for our later benefit than we would be giving away to charity in any tax year, most likely anyway. But the system is exactly the same. But what that has done, and it means it makes life easier for self-assessment tax returns, the administration of the tax system, because now there's no need for that information to go on to the self-assessment tax return for an individual who is just a basic rate taxpayer. They've had their tax relief at source, job done. But if you're a higher rate taxpayer, which is way more likely so far as any exam question is concerned, how do we get higher rate relief? Well, it breaks into two. The 20% relief we've already seen, we get at source. We paid £80, we get a £100 deduction going through, a £100 payment going to the charity. They get the £20 tax that you had suffered. Therefore, you only have to pay 80 to give them 100. How about the higher rate relief? Now, this is the most interesting bit. So pin your ears back for this one, because this is the doing exercise that you need to manage to deal with in the exam. This bit here. 20% through the income tax computation, obtained by, this is the bit, extending the basic rate band by the amount of the gross donation. So if we paid £80, the gross is 100. So your basic rate band limit, instead of being £33,500, goes to £33,600. If you paid £800 net, the gross is 1,000. The basic rate band limit, it doesn't stop at 33,500, it goes up to 34,500. So what that is doing is taking either in those examples an extra £100 or £1,000 of your income that would otherwise have fallen into the higher rate band and therefore being taxed at 40%, and instead push those figures of income back into the basic rate band, where instead they'll be only taxed at 20%. There's your extra 20% saving. So that is how we get higher rate tax relief. I repeat, get the gross amount of either the gift aid payment or the personal pension contribution and add that gross figure to your normal basic rate band limit. So the gross figure, first of all, amount paid times 100 over 80, add that to your 33,500 basic rate band limit. And if we move on, maybe less likely, to the additional rate taxpayer, then all we've got to do there is not only add that gross figure to the basic rate band limit, but also to the higher rate band limit. So if we paid 80, gross 100, the higher rate band limit doesn't stop at 150,000, it's 150,000 and £100. If you paid 800, given a gross 1,000, it's not 150,000 as the higher rate band limit, it's 151. So the gross amounts of gift aid payments and personal pension contributions will serve to extend the basic rate band. And that is where they get involved on the income tax computation. If you are only a basic rate taxpayer, it's going to have no effect on the income tax computation. You had your basic rate relief at source. Now, if we get up into the higher rate band, then as we saw back in section 3 of this chapter, that we could be dealing with if adjusted net income exceeds £100,000, a restriction, and maybe a total foregoing of your personal allowance of £11,500. But the figure that we compared with the income limit of £100,000 was an adjusted net income. Now again, remember, we know what net income is, at least I hope we do, off the income tax computation. Adjusted net income was net income less the gross amounts of these payments. As we said, both gross gift aid payments and gross personal pension contributions deducted in arriving at the adjusted net income figure of the taxpayer. That's what we need to be able to deal with. First of all, let's just go through an all basic income tax computation, as here with example 13. So what have we got? Elliot has a trading profit of £48,000 in our tax year and paid £1,600 charity under the gift aid system. So, one source of income trading profit, what is it? It's non-savings. Paid £1,600 to a charity, very generous indeed, under the gift aid system. Paid £1,600. Does it say next to the £1,600 in brackets gross? No, it doesn't. Therefore, that amount paid is the net amount. So what do we do next to that? Times 100 over 80 to turn it into a gross figure. 1,600 times 100 over 80, and you might guess it's going to be a nice round number, that will come to £2,000. There is your gross gift aid payment. The income tax computation. We've seen that we've only got non-savings, and that will also be your total income. What do we have? Trading profit here, £48,000. In it goes to your computation as usual. So the trading profit, it's the only income figure you've got. That's your total income, and it's also, of course, then your net income of £48,000. That's your net income as well. And away from that, we're going to deduct our personal allowance. Now here, do we get a full personal allowance? Of course we do. We're nowhere near an adjusted net income figure of £100,000. There's no restriction. We get £11,500. And again, deducting your analysis and your total column. So we will derive our taxable income figures. Our taxable income here is what? 36,500. Methinks there, £36,500. Now what you see there is no different to what we've ever done on an income tax computation. We have not involved the gift aid payment. It would be the same with the personal pension contribution. We have not involved that gross £2,000 at all. It has had no effect. It has not served to reduce that trading profit. All that has happened at the moment is the individual here, Elliot, was kind enough to part with £1,600, and the charity ends up with £2,000. Elliot's £1,600 paid to them, plus £400 of basic rate tax that Elliot had effectively suffered and paid over to HMRC in relation to the £2,000 of income from which the £1,600 payment was made. So there, it's had no effect. But the interesting thing about this, of course, is that we are a higher rate taxpayer. We're higher rate because as we look at that, we think, right, 36,500, that is more than 33,500, the basic rate band limit. But here we've got to be careful in terms of our calculation of the tax on what is our non-savings income. We are not just a basic rate, we are looking at a higher rate taxpayer. So non-savings, we need our basic rate, and for that we'll need a working one, whereby our basic rate band limit of 33,500 is increased by the gross amount of the gift aid payment. Now, we already know that that is £2,000, but showing it in our answer, we've scribbled it on our question page there, unless it's a computerised one, but we can now note it. That was the 1,600 times 100 over 80. Now, that 2,000 added to 33,500 takes us up to £35,500. So it means that instead of taxing just 33,500 of the taxable income of 36,500 at 20%, we get to tax now 35,500 at 20% using our extended basic rate band limit. We've got 36,500 to tax. It's all non-savings income. So when you're up into higher rate, there'll be £1,000 here. 1,000 on the 35,500 is obviously 36,500, the level of our total taxable income. That will be in the higher rate band and taxed at 40%. So it's only going to have an involvement here on the computation when dealing with a higher rate taxpayer, where we've got to establish the extended basic rate band limit, and if it were necessary, it isn't here, the extended higher rate band limit. In deriving the figures of taxable income, we've had to deduct, of course, the personal allowance, which here was the full personal allowance. There was no restriction in that because, again, adjusted net income, such as it is of course well below £100,000. If you were computing, there would be no reason to do it here. If you were computing the adjusted net income, then here it would be your total or net income of 48,000 less the gross gift aid payment of £2,000. Now that's an unnecessary calculation because we only have to do that when net income exceeds 100,000, which of course is what we are likely to see when we move to our next problem. If needs be, just pause at this particular point and then look at the model answer to the question we've just done, just to make absolutely certain that you're happy with that. But let's now look at example 14. Right, Thomas earned £160,000 of trading profit assessable in 1718. In that tax year, he paid £6,400 to charity, again, of course, as it will be under the gift aid scheme. Trading profit is non-savings there. 6,400 is amount paid times 100 over 80. That will be £8,000. What we know here is at £160,000, we are looking as if we are not just a higher rate, but an additional rate taxpayer. So let's do all our normal bits to begin with. Again, we've just got non-savings and total. We've got our trading income or trading profit, £160,000. In it goes, 160. That is also there our net income. I will identify it this time. The net income, one and the same, 160, 160, away from which we will be looking to deduct our personal allowance. Now then, our personal allowance, is there going to be any? Working one. Now, in terms of working one here, what are we saying? We need adjusted net income. Now, our adjusted net income is going to be net income of 160 less the gross gift aid payment. Again, as I say, whether it's gift aid or personal pension contribution, it's less the gross amount of those payments. Now here, do you think we're going to get any personal allowance? In working one, adjusted net income equals 160 net income minus 8,000 is the gross gift aid payment here, and therefore that's £152,000. Do I need to show any more workings? I hope we think no, we don't. Reason being, that is clearly in excess of £123,000, the number that we saw and used extensively back in section 3 again during this chapter. So all we need to note there is that as adjusted net income exceeds £123,000, there is no personal allowance available. So nothing to deduct there. So net income and taxable income are one and the same, the £160,000. But now, of course, we need to tax that taxable income. So what you've now got to do in working 2, as that would be, is to work out your extended basic rate and indeed higher rate band limits. So working 2, your basic rate band limit would be, what's your normal basic rate band limit, as we saw a moment ago? 33,500. Plus, what is the gross gift aid payment? £8,000. 33,500 plus 8,000, what's that? 41,500. So now as we tax this taxable income of 160, all of which is non-savings, we won't be taxing the first 33,500 at 20%. It will instead be our extended basic rate band limit of 41,500 at 20%. Again, look at what that has done. It has taken £8,000 worth of our taxable income that would otherwise have been in the 40% band and pushed it back into the basic rate band, and therefore we've only been charged at 20%, thus achieving the higher rate tax relief for us. We now need, for working 3, of course, here, pardon me, I was trying to fit this in, a calculation of the extended higher rate band limit. Now that, of course, would be 150,000, your normal higher rate band limit, and that is now plus 8,000 equals £158,000. So we've taxed 41,500. The extended basic rate band limit is 158. So take 41,000 away from 158,500, and hopefully what that gives us is 116,500 to be taxed at 40%. Again, just check there. 500,000, carry 1, 42, 116, yes, 158,000 there. But our taxable income was 160. So there's still another £2,000 to take account of. Again, if you're, hopefully you would have more room, of course, on your working. But that will leave us with a further £2,000 of our income to be taxed at 45%. It's now calculator time. Put that through your calculator, work out your income tax liability, and see what you get. Okay, I'd like you to go back through that example, review very carefully through the answer to that in the back, and then have a little go at example 15 here. Again, it's an income tax liability that needs to be computed. This time, the numbers are somewhat more interesting than the one that we've just done. Trading profit, non-savings, 98,000. Bank interest, 4,000. Savings income. Dividend income, 6,000 there. She paid interest of 3,000 on a loan to contribute capital into a partnership. A qualifying loan interest payment. How do we deal with those? Those are deductions from total income in giving you net income. Remember that. She also made a payment of £4,800 to a charity under the gift aid scheme. That again is the amount paid, so times 100 over 80 to give you the gross figure. What you're now going to have is an income figure, an adjusted net income, that does not exceed 123,000. So you're going to have to work out, as you do this computation, what that revised personal allowance will be and what the extended basic rate band limit will be. High rate band limit won't be an issue. You're not going to have income in excess of £150,000 here, as we did in the previous example. And I'd like you to try and work that one out for yourself. What we'll then do at the beginning of our next session is to review through the answer to make certain that you did indeed fully understand that. because that is very much the style of an exam question that you could see. One of the most difficult ones that we had to do so far. Make sure that you are okay with it. I will review it with you next time.